What is the relationship between inflation and interest rates? Inflation and interest rates tend to move in the same direction because interest rates are the primary tool used by the Federal Reserve, the U.S. central bank, to manage inflation. The Federal Reserve Act directs the Fed to promote maximum employment and stable prices. 1. Since 2012, the Federal Reserve has targeted annual inflation of 2 as consistent with the stable prices portion of its dual mandate. The Fed targets a positive rate of inflation, defined as a sustained rise in the overall price level for goods and services, because a sustained decline in prices, known as deflation, can be even more harmful to the economy. The positive level of inflation and interest rates also provides the central bank with the flexibility to lower rates in response to an economic slowdown. 2. In August 2020, the Federal Reserve adopted average inflation targeting. That framework committed Fed policymakers to hold inflation above 2 for a time to compensate for stretches when the inflation rate fell short of that target. 3. Key takeaways. Interest rates tend to move in the same direction as inflation, but with lags, because interest rates are the primary tool used by central banks to manage inflation. In the U.S., the Federal Reserve targets an average inflation rate of 2 over time by setting a range of its benchmark federal funds rate, the interbank rate on overnight deposits. In general, higher interest rates are a policy response to rising inflation. Conversely, when inflation is falling and economic growth slowing, central banks may lower interest rates to stimulate the economy. The Fed plans to continue raising interest rates in 2022 in order to curb the highest rates of inflation in 40 years. How the Federal Reserve measures inflation. The Federal Reserve's preferred inflation measure is the Personal Consumption Expenditures Price Index. Unlike the Consumer Price Index, TP, which is based on a survey of consumer purchases, the PC Price Index tracks consumer spending and prices through the business receipts used to calculate the gross domestic product, GDP. 4. The Fed also closely watches the Core PC Price Index, which excludes food and energy prices that are typically more volatile and tend to be less reflective of the overall price trend as a result. How changes in interest rates affect inflation. When the Federal Reserve responds to elevated inflation risks by raising its benchmark federal funds rate, it effectively increases the level of risk. Free reserves in the financial system, limiting the money supply available for purchases of riskier assets. Conversely, when a central bank reduces its target interest rate, it effectively increases the money supply available to purchase risk assets. By increasing borrowing costs, rising interest rates discourage consumer and business spending, especially on commonly financed big-ticket items like housing and capital equipment. Rising interest rates also tend to weigh on asset prices, reversing the wealth effect for individuals and making banks more cautious in lending decisions. Finally, rising interest rates signal the likelihood that the central bank will continue to tighten monetary policy, further tamping down inflation expectations. 5. Problems with using interest rates to control inflation. As the chart above shows, policymakers often respond to changes in economic outlook with a lag, and their policy changes, in turn, take time to affect inflation trends. Because of these lags, policymakers have to try to anticipate future inflation trends when deciding on rate levels in the present. Yet the Fed's adherence to its inflation target can only be gauged with backward-looking inflation statistics. These can range widely amid economic shocks that can sometimes prove transitory and other times less so. 0.75, 1.0. The target federal funds rate, announced by the Federal Reserve on May 4, 2022. 6. In short, if making monetary policy is like driving a car, then the car is one that has an unreliable speedometer, a foggy windshield, and a tendency to respond unpredictably and with a delay to the accelerator or the brake. Former Federal Reserve Chair Ben Bernanke said in 2004 while still a Fed governor. 7. Central banks trying to anticipate inflation trends risk making a policy error by needlessly stoking inflation with rates that are too low or stifling growth by raising them. 8. In the case of the Federal Reserve, it must pursue its stable prices objective while also trying to maximize employment. The delicate dance of inflation and GDP. Interest rates as a monetary policy tool. The Federal Reserve uses the federal funds rate as its primary monetary policy tool. 9. The federal funds rate, targeted as a range since 2008, is the overnight rate at which banks lend to each other over the very short term. 10. Traditionally, the Federal Reserve used open market operations, purchases and sales of securities, to adjust the supply of banking system reserves and hold the federal funds rate on target. 11. Demand for reserves was the result of banking reserve requirements imposed to ensure the soundness of banks. In the years following the 2008 global financial crisis, the focus of bank regulation shifted to capital buffer requirements and stress tests to ensure long-term solvency. In 2019, the Fed unveiled a policy of targeting the federal funds rate with two other rates it sets outright. 12. The interest on reserve balances, IORB, rate is what the Fed pays banks for overnight deposits in their Fed accounts. It sets an effective floor under the federal funds rate. Overnight reverse purchase agreements are a supplementary tool that pays a somewhat lower interest rate to non-bank money market participants for overnight deposits. 13. In 2020, the Federal Reserve eliminated reserve requirements for banks and other depository institutions. 14. The bottom line. Interest rates and inflation tend to move in the same direction, but with lags, because policymakers require data to estimate future inflation trends, and the interest rates they set take time to fully affect the economy. Higher rates may be needed to bring rising inflation under control, while slowing economic growth often lowers the inflation rate and may prompt rate cuts. The Fed targets a range of the federal funds rate, in part by setting the rate it pays on banking reserve balances. Inflation's impact on stock returns. Investors, the Federal Reserve, and businesses continuously monitor and worry about the level of inflation. 1. Inflation. The rise in the price of goods and services reduces the purchasing power of each unit of currency. Rising inflation can be harmful. Input prices are higher. Consumers may lose purchasing power unless their incomes rise, and monetary policy measures to contain inflation can damage growth and employment. Key takeaways. Rising inflation can be costly for consumers, stocks, and the economy. Value stocks perform better in high inflation periods, and growth stocks perform better when inflation is low. Stocks tend to be more volatile when inflation is elevated. How does inflation affect stocks? Inflation hurts stocks overall because consumer spending drops. Value stocks may do well because their prices haven't kept up with their peers. Growth stocks tend to be shunned by investors. This negative impact of rising inflation keeps the Fed diligent and focused on detecting early warning signs to anticipate any unexpected rise in inflation. 2. The sudden increase in inflation is generally considered the most painful, as it takes companies several quarters to be able to pass along higher input costs to consumers. 3. Likewise, consumers feel the unexpected pinch when goods and services cost more. However, businesses and consumers eventually become acclimated to the new pricing environment. These consumers become less likely to hold cash because the value over time decreases with inflation. High inflation can be good, as it can stimulate some job growth. 4. 5. But high inflation can also squeeze corporate profits with higher input costs. 6. This causes corporations to worry about the future and stop hiring, reducing the standard of living of individuals, especially those on fixed incomes. For investors, all this can be confusing, since inflation appears to impact the economy and stock prices, but not at the same rate. Because there is no one good answer, individual investors must sift through the confusion to make wise decisions on how to invest in periods of inflation. Some types of stocks tend to perform better during periods of high inflation. Inflation and stock market returns. Examining historical returns data during periods of high and low inflation can provide some clarity for investors. Numerous studies have looked at the effect of inflation on stock returns. Unfortunately, the studies have often produced conflicting results. 7. Still, most researchers have found that higher inflation has generally correlated with lower equity valuations. 9. This has also been shown in emerging countries where the volatility of stocks is greater than in developed markets. 10. Since the 1930s, the research suggests that almost every country suffered its worst real returns during high inflation periods. Real returns are nominal returns minus inflation. When examining SEB 500 returns by decade and adjusting for inflation, the results show the highest real returns occur when inflation is 2 through 3. Inflation greater than or less than this range tends to signal a U.S. macroeconomic environment with larger issues that have varying impacts on stocks. 11. Perhaps more important than the actual returns are the volatility of returns inflation causes and knowing how to invest in that environment. Growth Vs. Value stock performance and inflation. Stocks are often subdivided into value and growth categories. Value stocks have strong current cash flows more likely to grow slowly or diminish over time, while growth stocks are likely to represent fast, growing companies that may not be profitable. 12. Therefore, when valuing stocks using the discounted cash flow method in times of rising interest rates, growth stocks are negatively impacted far more than value stocks. 13. 14. Since interest rates are usually increased to combat high inflation, the corollary is that in times of high inflation, growth stocks will suffer more. What is inflation? Inflation is the rate of the broad general increase in the prices of goods and services over a period of time. Why is inflation bad for stocks? Rising prices of goods and services injects uncertainty into the markets. During periods of rising inflation, corporations' profit and growth margins may be hit, affecting investor confidence, which in turn affects their willingness to take on risk by holding stocks. Who gets hurt the most during inflationary periods? Usually those who are in the lowest income groups who spend the bulk of their income on essential goods will feel the pain of increasing prices the most. The bottom line. Investors try to anticipate the factors that impact portfolio performance and make decisions based on their expectations. Inflation is one of the factors that may affect a portfolio. In theory, stocks should provide some hedge against inflation because a company's revenues and profits should grow with inflation after a period of adjustment. However, inflation's varying impact on stocks tends to increase the equity market volatility and risk premium. High inflation has historically correlated with lower returns on equities. Value stocks tends to perform better than growth stocks in high inflation periods, and growth stocks tend to perform better during low inflation. How does inflation affect fixed income investments? A high inflation rate will reduce your real return. Inflation can have a negative effect on fixed income assets when it leads to higher interest rates. It usually does. Central banks like the U.S. Federal Reserve typically set inflation targets, and when inflation exceeds the desired threshold, they raise interest rates to bring it under control. Since the interest payments from existing fixed income assets become less competitive relative to newer higher-rate fixed income instruments, the prices of existing fixed income assets in the bond market will fall. In other words, there's an inverse relationship between interest rates and fixed income asset prices. High inflation also undermines the returns investors get from fixed income assets. You'll receive the same amount of cash, but it no longer buys as much as it did when you chose the investment. Key takeaways. Fixed income instruments include corporate and government bonds and bank certificates of deposit, CED. The prices of fixed income assets move in the direction opposite to their yields. Inflation typically occurs during periods of economic strength, which forces increases in the costs of wages, merchandise, and commodities. The Consumer Price Index, CP, and Producer Price Index, PI, are economic indicators that are commonly used to measure inflation from month to month. What drives inflation? Inflation is a sustained increase in the price levels of goods and services throughout an economy. There is no unanimous consensus on the primary cause of inflation, but most economists agree that it tends to surface during periods of strength in the economy. It also can appear when there is a sudden and dramatic increase in price for a core commodity such as oil or wheat. When unemployment rates fall, companies are forced to raise wages, leading to an increase in production costs. Those increases are passed along to the consumer in the form of higher prices for goods and services. Inflation can occur when a country's government prints more money than is justified by the country's wealth, causing the value of the currency and its purchasing power to decrease. Inflation and interest rates. Fixed income assets are investments in the debt of a government or a company. They deliver regular payments, sometimes called coupons, to the holders of the debt until the date they reach their maturity. The initial investment is then returned. Examples include corporate bonds, federal, state, and municipal bonds, and bank certificates of deposit, CDs. For instance, a company may issue a 5s corporate bond with a $1,000 face value that matures in 5 years. This means that the bond will pay its owner $50, fivers of $1,000, per year for 5 years, at which time the $1,000 will be returned to the investor. Now, suppose that during those 5 years, inflation drives up interest rates. That adversely affects the investor in several ways. In the bond market, that company and all other bond issuers might now have to pay 6 in interest to find investors for their new bonds. The holder of the 5s bond will not be able to sell it at its full $1,000 face value. It might be worth around $850, minus the amount already paid out in interest, which translates into an annual yield for its new owner of 6. The bond investor's alternative is to hold on to the bond until it reaches its maturity, collecting the 5A payments and getting back the full $1,000 face value at maturity. However, inflation has reduced the real spending power of both the interest payments and the $1,000 that is returned to the investor. Investors talk about opportunity cost. This is the shoulda, coulda, woulda factor. A 5-year commitment to a 5-year commitment to a 5 return has denied the investor the opportunity to make a better return for that $1,000. Time matters. The longer term of a bond, the greater the risk that inflation will hurt the investor's real return. Fixed income assets can be found with terms ranging from a few months to 5 years or more. The longest bond offered by the U.S. Treasury is a 30-year bond. An investor in a 1-year bond is taking less risk that inflation will erode its value before the bond matures. Inflationary risk. Understanding the difference between nominal and real interest rates illustrates how inflation harms fixed income assets. A bond's nominal interest rate does not take inflation into account. A fixed-rate bond is just that. If it says 5 ED, the investor will be paid 5. If that translates to $50 a month, the investor will get $50 a month every month, whether the inflation rate is up, down, or 0%. But if inflation has reduced spending power, that investor's $50 is worth less in the real world. As an extreme example, consider the fact that $100 in 1900 was worth the same as $3,527, 10 cents in 2022, when the numbers are adjusted for inflation. 1. Real interest rate establishes the investor's actual return by subtracting inflation from the nominal interest rate. For example, if the nominal interest rate is 4 and inflation is 3, the real interest rate is 1. If inflation is higher than the nominal interest rate, the bondholder's return is not keeping pace with the rising cost of living. While many investors rely on bonds as a predictable source of income, periods of high inflation will undermine their returns. This is known as inflationary risk. Key PVs. One of the most problematic aspects of inflation is that its impact on investments is not stated explicitly. Instead, investors monitor economic indicators like the Producer Price Index, PI, and the Consumer Price Index, PI, to get a sense of inflation trend. When economists talk about inflation, they're usually referring to a rise in the Consumer Price Index, which tracks overall prices at the retail level. The Producer Price Index tracks changes in the prices of consumer goods and capital goods paid to producers, mostly by retailers. That means that an inflationary trend will show up earlier in the PI than in the CPI. So the PI can be useful to investors as an early signal of impending inflation. Frequently asked questions. Why are interest rates and bond prices inversely related? Bond prices move up when interest rates fall, and vice versa. This is because bonds that pay a fixed interest rate will become less attractive when new bonds are issued with higher yields. When those older bonds are sold, they will trade at a discount. But if interest rates fall, newly issued bonds will yield less. That makes the older ones more attractive. They will then trade at a premium to their face value. Is inflation good or bad for stocks? Stocks generally hold up better than bonds to inflation, and the effects are more varied and less automatic. Producer price increases inevitably lead to consumer price increases, but it may take time. As companies delay passing along those additional costs, their current revenues can drop and their stock prices can drop in response. In general, value stocks tend to perform better in high inflation periods, and growth stocks perform better when inflation is low. Which assets hedge against inflation? Historically, real estate, gold, and other commodities have been seen as inflation hedges. Empirical work, however, reveals that these asset classes do not always live up to their reputation in this regard.